Here's how you could have turned $10,000 into over $176,000 with just one simple move. Today, I want to talk to you about the power of patience. When it comes to long-term investing, there are some key lessons that we can take from this, which I want to break down for you in this video. Now to start with, just have to give a couple disclaimers. So obviously this video is general in nature, doesn't take into account your personal circumstances, financial situation or needs. So please reflect on it before acting on it. Also, past performance isn't an indication of future performance. And for the full list of disclaimers and assumptions, please refer to the Vanguard website. Now, in this video, I want to break down this chart. Now, it might seem pretty complicated, but let me just simplify things for you, break it down into bite-sized chunks, and then I'm also going to have a key summaries section after this as well, which just summarizes everything that I run through. So this chart is essentially tracking the historical returns of different investments over the last 30 years, okay? Now you can see on the graph here, there's a few different lines happening, and what's happening here is, let's say 30 years ago, you had $10,000. It then tracks how it would have performed over that 30-year period if you just put it there and you left it, okay? So as you can see here, we have cash, bonds, property, shares, and then inflation as well. So these dollar figures here is what that $10,000 would have done after 30 years, okay? Now, the other thing that I want to make out of this is, let's go back again, 30 years, you had $10,000. Let's say you just had that $10,000 under your bed. 30 years later, it's going to be still $10,000. You didn't take any risk with that money, but you didn't get any return either. So with investing, there's a risk and return relationship. If you're not taking any risk, you're not going to get any return. And then if you're taking a lot of risk, you can potentially get a lot of returns as well. Now, if you had $10,000 at this point here, things that cost you $10,000 30 years ago, today would cost you close to $22,000. Now this is all thanks to inflation, and we can see over a 30-year period, it's actually averaged 2.7% per annum. It's obviously been a lot more in recent times, but this really does highlight the fact that if you don't invest, the purchasing power of your money is going to reduce pretty much year on year, and then eventually the cost of living is just going to catch up with you. So it's very, very important to invest if you're looking to grow your wealth in the long run and stay on top of inflation and being able to actually purchase things comfortably later on. Now, as you can see here, if you had your money in cash over this 30-year period, you can see it's a very steady line. It's averaged 4.2% per annum, and it'd be worth $34,000 today, essentially. And even though, yes, it hasn't bounced around a lot, there is potentially a time and a place for this in a traditional portfolio. When it comes to Islamic investing, we obviously want to stay away from interest. So cash and Australian bonds as well, 5.5%. These are called defensive assets, okay? And they're essentially, interest earning investments. And yes, they don't bounce around too much, but the problem is, as you can see, over the long run, they've actually underperformed compared to the other investments there. So the other thing to take from this is, putting aside the whole Islamic investing, if you have a very long investment time frame ahead of you, let's say you've just started paying yourself some super, if you've got a long investment time frame, you probably don't want to be in these defensive assets because it's just going to drag down the portfolio. You do want to be, generally speaking, in these higher growth assets here. Okay. Now, Australian listed property, you can see $10,000 30 years ago. Today, if you just left it over that period, it would be worth $83,000, and it's averaged about 7.3% per annum, which is this maroon line here. Now you can see property has obviously bounced around a fair bit, especially here during the GFC where property took a big tumble. But you can see if you just kept it invested, then COVID hits, but eventually it comes back up, and it's still averaged a positive return of 7.3% over 30 years, which is quite good. Now, if we compare it to international shares, that's averaged 7.5%. Now, these are the two big performers here. Australian shares, 9.2%, okay? Now, 10,000 bucks, if you just left it there, 138,000 today. That's if you kept it invested during that entire 30-year period. And the same is with US shares, 176,000. So as you can see, over this 30-year period, a lot has happened. We've had the dot-com boom, we've had the GFC, we've had COVID, we've had wars, we've had elections, we've had everything, you name it. But by simply putting the money 30 years ago, letting it do its thing over time, trusting in the markets over the long run, you can see you would have been rewarded for that patience. And the big performer here is the US stock market, with averaging 10% per annum, which is quite incredible. Now, the big one here is, the recent one, which might, we might be able to reflect on that because it's fresh in our memory. We can see COVID. As you can see, during COVID, there was so much unknown, and rightfully so. And markets did drop a bit. You can see the US stock market did drop a little bit. Australian shares did drop a bit. But I want you to pay attention to how quickly it came back, okay? If you didn't panic, if you just left your money, let it do its thing, it just came back. And it did really, really well as well. So I just want to break down some of the key lessons we can take from this now. Number one, inflation is the enemy, as we've discussed. You do really need to invest if you want to stay on top of it in the long run. Again, highlighting the importance of investing too, particularly in those higher growth investments. Staying the course, keeping it invested. It's okay. Markets are going to do their thing, but if you have that longer time frame of, say, 5 to 7 years plus, you can have some general confidence knowing that markets will, generally speaking, they're going to go up over time. The other big one here is don't panic, okay? Now, things happen in the market, there's always going to be uncertainty, but just have that faith that things will recover and improve over time, inshallah. Now, growth assets has outperformed defensive assets, as we've discussed there as well. So if you're young, generally speaking, if you've got that long time frame ahead of you, try to maybe avoid defensive assets, particularly if you're into the Islamic investing, which is what we specialize in here. You definitely want to avoid that. You can look at some other defensive alternatives, such as gold, as an example. The other one, diversification is key. You don't want to put all your eggs in the one basket. You can see the US stock market, for example. Yes, it did average 10%, but there would have been over 500 companies in that index that we're tracking there. So you don't want to put all your eggs in that one basket. And the other one that I want to highlight here, which I haven't put, is the relationship between risk and return when it comes to investing. As I've discussed, with investing, there's a risk and return relationship. If you want to get a return, you generally have to take some risk in order to achieve that, and the opposite's true. And the other point that I do want to make is by sitting in cash or simply having the money stashed under your bed or whatever you may be doing with it, you might be thinking you're not taking risk with your investments, but the fact is, you're essentially guaranteeing yourself a loss when it comes to inflation. Now, if you aren't earning more than inflation, then you are guaranteeing yourself a loss. Your money is effectively going backwards. So it's very important to earn more than inflation. Now, this is just one of the principles that we take with our clients when it comes to investing. If you want to achieve financial freedom, then please feel free to reach out to us. Many thanks, guys. Assalamu alaikum.